Welcome back, everybody. So, now that we finally went through our first section, which was chapter 5, dealing with our periodic purchases, right? We got to see what it looks like when we make our purchases and what it takes to calculate the cost of goods sold at the end of the period, right? Now, we're going to be introducing to the second portion of the periodic inventory, which is calculating and journalizing sales. Okay, so 6.1 is actually focusing on sales. Now, of course, I also have to make sure that you guys remember that this is entirely revolving around the nature of the business, which again is the purpose of making a profit. So when we're looking at a selling price, we need to make sure that we determine a few things. That the selling price, right? The ultimate goal is, again, to make a profit. And how do we do that? Our selling price must consist of the cost of just, actually, wait, hold on, I'm on the wrong side. Okay, so here we're the whole initial thought process on understanding what we do when we do sales is we're buying merchandise inventory, right? Our goal is to create we're selling the product for cash. And with the selling price, it's going to include all the costs it gets to that you incur in order to get the asset to your store. Okay, and then you also need to include a profit margin or a profit percentage, right? Because the ultimate goal is you want to make sure that all things first is that all of the costs that you've incurred to get the item to your store is covered 100%. You never want to pocket out anything, right? Because then that defeats the purpose of even making a profit in the first place, right? Why would you sell an item at the cost value without making any money on top of that? Okay, so the selling price is going to be determined by the cost of the item plus whatever profit percentage that you want to receive for selling the product. Okay, so again, of course, with that being said, you must charge sales tax to products that you sell in the store. Okay, this also applies to what state you belong to, right? Not only does it apply for the state, it also applies to the county you belong to as well. So sales tax we'll talk about more about that in depth more in QuickBooks, but also when we're dealing with this, this was earlier in the previous years it was 8.25% in obviously the county of Summerlin Parkway. Okay, Summerlin region. Okay, but if you go into Henderson or go into Reno County, obviously it's going to be a little different, but I believe it has changed slightly. I believe it's 8.375 if I'm not mistaken percentage, but that's okay. For the sake of class, I don't need you to know exactly where the location that you are as far as where you're selling this product at, right? It will just depend on where you open up your location and what the state or the local government is going to charge you. Okay, so in this case, for this class, I want you to just focus on 8.25%. Okay, make it really sweet and simple. No extra numbers to have to punch in. I just want you to know 8.25% for now. Okay. Now, with that being said, let's go ahead and let's look into how periodic inventory sales actually works, or how to journalize them. Okay. So in this example here, on June 1st, we sold 10 items at $9.99 each. Sales tax is 8.25%. Record this transaction. Okay. All right.
Oh, so let's see here. So you want to put the date, obviously.
Mm-hmm.
description are you? Uh,
Okay, so in this case, I wasn't specific on how I received the money, so I'm just going to assume, right, either or, I'm going to be either receiving cash or someone's going to owe me the money on an account.
okay.
Okay,
So receivables.
okay, yes, that's going to be the first
Okay.
thing. What is my other part of the journal going to reflect?
Is it going to be the sales tax?
Sales tax is one of them, yes, but are you going to put it on the debit side or the credit side?
The credit.
Correct. So what is the other portion, right? Sales tax is obviously something that you have to calculate separately, right? So what is my main account that I'm going to actually be journalizing? What is yes,
I know
sales.
we're missing it somewhere here.
Okay? We're going to be introducing sales and sales tax payable, okay? Now, let's go ahead and determine what is sales. What type of an account is sales?
Sales, selling of the product, the service, the merchandise, whatever.
Okay.
Revenue.
Revenue. Thank you. Account type. It belongs as a revenue. Yes, it's the income. It's where we earned our own money. Now, I'm going to ask you this question. Sales tax payable. Is sales tax payable actually our money?
No.
No.
No, it's money that we collect from our customers that we need to do our duties to pay the local government to for whatever reasons because they're the ones that tell you, hey, you need to charge sales tax. So then we can, collect that from you. So in this sense, it becomes a payable because this is not money that is actually ours. It's money that we're holding on to give to the government. It belongs to the government. Okay? So that's why it's something that we owe. All right? We're going to be given a wad of cash, right? But for us to make sure that we have two separate accounts to actually determine what is actually ours that we get to keep and pocket ourselves and what is the portion of the money that's actually going to be considered something that we owe to the government. Which in this case, what did I calculate my total sales to be?
$999.
$999. And what is the tax going to be off of those $999? I'm sorry, $99.90.
The tax is $8 and 249,175. Now, do you just want us to round up like normal?
Yes, because can you give someone a half of a quarter?
No, you may.
No, you can't. You cannot. So this is definitely you need to round your answer for sure.
$8.25.
Good. Okay. Wait. Let me see. I don't think so because it's
I know
90.
how I always did it, but I didn't know how you know, do it with all the decimal points afterwards. But I get you.
Okay.
Straight up.
So it's not 25 cents, but it's 24 cents. You're off by 1 penny. Because it's not $100 that we're incurring. It's only $99.90. So we're off by
So
10 cents.
that's what I was saying. So on my calculator that I already have set, it already tells me that it's the 8.249. Why wouldn't in the real world I'm rounding up?
How did you get 9?
I said when I did the 99.99 times.
Okay. 9 this is only $9.99 times 10. You added an extra 9 cents in there.
No, because I'm doing the total. You're not taxing $9.99.
No, it's okay. No. Calculate $9.99 times the 10 items.
Yeah, that's 99.99.
99.90. You have too many nines.
90. Oh, sorry. Gotcha.
There you go.
40.
There you go. And then you take that and you multiply it by the tax percentage to get you your $8.24 175. Correct. Simple, easy mistake. It's okay. I got you. Okay. So good. We're going to recognize that we're going to receive a total amount of cash or whatever the person's going to owe us for the total amount. We're going to separate our sales, which we've already calculated, right? It's $999 times 10 gives us $99.90. Okay? And we know that tax is going to be the 8.25% on top of that, giving us a rounded number of $8.24. So, what is the total amount of cash I'm actually going to be receiving?
$108.14.
$108.14. So again, in real life, if you are the customer or the vendor, whoever you are, if you're the store and you're collecting the money, are you actually going to pay your item separate from your sales tax?
When you're the customer, no.
No, you just give them the money the way it is. Boom. Okay. So as a person who is selling the item, the store owner, you have to make that fine line to make your, you need to make sure that you separate it because, again, a portion of that money, 8% of that money is actually not yours. It belongs to the government. Okay? So making sure that this is how you keep it separate, but also total about the total amount of money that you're actually receiving. So in this case, you get a real reflectant of the actual profit or the actual sales that you incur without the tax included. Okay? And that's it for sales. Any questions?
No.
Okay. Good.
That's pretty easy.
Yep. So, under periodic, okay, we understand the definition of periodic is that we don't care too much about our inventory items, right? We update it every once in a while, right? So this is where we do not need to update our inventory. Even though we sold something, we don't care to calculate it until the end. Remember when we did our cost of goods sold? When did we actually do that calculation?
At the end of the month.
At the end of the month. Or in that case, yeah, at the end of the month or the end of the period, okay? So in this case, when we're journalizing for periodic sales, we do not need to have an additional cost of goods sold or take out of inventory directly, okay? So in this case, that's all that we incur. We only recognize that we just have the sale and we're done, okay? All right, so that was 6.1, all right? Now, of course, with 6.2 is, of course, we're going to have customers who would love for returns and allowances, okay? So with that being said, of course, number one reason that a customer would want to return an item is purely because maybe the item that they bought was broken or defective. It could be that they just don't like the product itself. And or they could be, they're just completely unhappy with the item that they got, right? So a lot of people that buy gifts for people, they don't like it, they don't want to tell the person, they just go to the store themselves and exchange it or whatever reason, right? So again, you will be encountering, of course, if you have sales, you have to encounter a return and an allowance policy, okay? With that being said, with the company policy, you need to determine on what your return policy is because ultimately your whole goal is to sell your products and you want to keep it sold. You don't want to give the customer back their money. So what other incentives you can do is what I've seen before is you put a cap date on when you can allow a customer to return a product. All right. So usually it could be anywhere from 7 to 14 days, or even some policies can go as far as 90 days. They'll let you return it after 90 days. So think people like QVC, they love to sell their products, but their fine line is you could get your money back guaranteed. Full refund after you utilize the product for 3 whole months. You could get a full refund if you are not happy with it. Okay? So, again, it just depends on the company and what policy you actually place on your customers. Okay? And if for those that don't want and just want to make sure that they try to keep their items sold, what they do is that you can either do a full refund or you could do store credit. Store credit meaning, oh, if you return this, I can only allow you to give you credit. So then you come back to my store, and of course, no matter where you're at, you're stuck with me because you have to buy something from my store. Okay. Other things are going to be final sale, like, oh, I'm sorry, I don't do refunds. This is final sales. Other places do. They could either issue a new product again, or they could do exchange policies. So again, it's just depending on your policy and what you want to do with your customers. Again, you want to make sure that you keep them satisfied as well. But if you don't really care about your customers, then you make a policy that makes it strict. Okay. And with that being said, when you incur obviously a return or an allowance, you need to include the sales tax, as in you're returning the customer for what they've paid for. Therefore, you need to give them back the portion of the sales tax that they've placed and put into the government. You need to give a portion of that back. Okay? So again, if you've ever gone to the store, you don't get just what the price is for, the product that you bought it for. You also get a portion of your tax back as well. Okay? So let's go ahead and do this example. So in this case, I'm going to encounter a sale. So on May 1st, you sold 50 coffee mugs for $5 each. Sales tax is going to be 8.25%. So customer A pays with cash for these mugs. Okay, so this question is now asking to record this sale. So what is my journal going to look like?
Your description, are you going to call it cash?
Mm-hmm. That's what we received, right?
Yeah.
Yeah. Okay, we received cash. Okay.
Let's see here. So the total amount is without tax is $250.
Okay.
Okay. So the total there for cash is $270.62.
Okay. So again, we're going to be placing our foundation, right? We recognize that we're going to be receiving cash, right? We know that we're going to be receiving our sales, right? That's what we're recording is our sales. And we know that we need to also keep our sales tax completely separate because that's not our money, that's the government's money. So here my journal is going to look like this. We are increasing our asset because we received cash. We're increasing our sale, which is a credit, and we're increasing our liabilities, which is the amount of money that we owe to the government. So with that, you did calculate that, so good. So we should get a total of $270.63. Okay, so for the sales itself, it's going to be the price, the selling price times the how many items that we sold, which is $250. We're going to multiply it by the 8.25% to give us a total of $20.63 of tax. Okay? Good. All right. Now, let's see what happens when we need to deal with the sales returns and allowances. Okay? So on May 10th, okay, customer A wants to return 10 cups for a full refund. Okay, your company's return policy was a full refund within 15 days. Record this transaction. So we originally bought it on the 1st of May. Now, 10 days later, they decided to return it. So do we grant them the full refund?
Yes.
Yes, we do. They're only refunding 10 of the 50 mugs. So what are we going to be, what is our journal going to be looking like? Okay. What do you guys think is going to happen?
Well, so let's see. The description is going to be the refund amount, right? For the debit.
Okay.
Returns, allowances, or whatever.
Correct. We're going to be dealing with a sales, returns,
Okay.
and an allowance count. Good. Okay. This is going to be a contra account, right? It's going to initially reduce your sales. Sales is completely finite, as in that's it, it's done for. But in order to reduce it, we're going to create a contra account, which is sales, returns, and allowances, okay? And then lastly, what are we going to actually refund to them? How did the customer originally pay us?
Cash.
With cash.
Yes. So we're returning the cash, but we also have to return the sales tax that was also involved with the actual, exactly. So let's go ahead and calculate it. If we originally sold each cup at $5, right? How much? $50 for the sales, returns, and allowances, right? How much of that is going to actually be considered sales tax?
None of it. The full $50 is the mugs, and then the sales tax is $4 and 4.125.
Good, which we're going to round it to 13 cents. So my total cash that I'm going to be giving back to them is going to be $54.13. Okay, this is us reducing the amount that we owe, right? Because we're giving them a refund, we no longer owe the government that money anymore. We got to give it back to them. So we're going to reduce our liability by debiting our account. Okay, by debiting our liability account. We're reducing and lowering the money that we owe. And then lastly, we also have to reduce our assets because we're ultimately getting back their money. Okay? And that's it for this one. Okay? Any questions on returns? This is just returns only. Okay? All right. Now, the next scenario is, let's say on May 18th, which the person already passed our policy, right? May 18th, customer A wants to return 10 of those coffee mugs for a full refund. However, the customer doesn't like the color and tells you that, wait, hold on. And you tell that the customer has that they have missed the refund period, okay? But they're at your store, they're super angry, and they're demanding that full refund. So what you've decided to do is you decided to give them an additional 15% discount. You can keep the cups. I know they're the wrong color, but you know what? How about I make a deal with you? I'll give you an additional 15% discount, okay? You've already missed the return policy. I cannot give you a full refund. However, you know what? I can give you a nice discount just to keep you happy and keep you coming back to my store. So let's go ahead and record this transaction. Okay? So what is my journal going to look like?
So in this one, are you going to make a description of, so again, like sales discounts and allowances, or
Okay. Now,
just still sales and allowances, or sales purchases, or no, returns and allowances?
Yes, sales, returns, and allowances, because we're attempting to return. Okay, and we'll talk about sales discounts right after this. We're attempting to return, or the customer is attempting to return, but we said no. This guy's keeping, like, yelling at us, trying to do something to us, right? And our best way is, in order to calm down, we either give him a voucher or to say blah, blah, blah. That's it, right? So in this case, I'm going to give an allowance for him for 15% discount. Okay, so the difference between a discount and an allowance is with the discount, it has to be applied to every single person in the store. This one, it doesn't apply because this is on a one-to-one basis, right? This person is trying to return something, but we said no, so we give them an allowance, right? A credit. We say, hey, maybe you can apply it for the next item that you buy, okay? XYZ, right? In this case, it's just an allowance. So good, we're going to be recognizing a sales returns and allowance. What else do you need to incur as well?
The sales tax.
You need the sales tax. Good. And what else do you need to incur? How did the customer pay?
Cash.
Oh, still cash, yeah.
Yeah, we're refunding with cash. Okay, so let's go ahead and calculate this total amount here. Okay, so they're gonna get an allowance. Okay.
Yeah, I'm sorry, I forget the price of the mugs. Were they $5?
Yes, they were $5. Yes,
Yeah.
correct.
So it's $7.50.
$7.50 is just the returns and allowance. That's what we're giving the allowance for. Now, how much of the $7.50 are we refunding the tax for?
$0.62.
62 cents, okay? Bringing us a grand total of $8.12 we're actually giving back to them, okay? So in this case, again, they paid into their sales tax, so therefore our duty is if we give them anything, right? A discount is they're still making a purchase of your items, but they're not paying it in full. So therefore, you need to do the best that you can to calculate that small percentage, right? It's not based on how many items they buy, it's based on the total value of the cost of the sales cost, okay? So in this case, good. Right? So that is sales returns and allowances for you, right? Any questions in regards to it? It's a pretty straightforward concept.
Yeah.
Okay. So now we're going to talk about 6.3, which is going to be dealing with our sales discounts. Okay. So again, when we have when the company decides to have a sale, right? This is where we're going to be deciding whether it's a store-wide sale, an online deal, or even whether if you're buying in bulk or you have someone that's selling in bulk, you might give a little friendly discount for those wholesaling products. Okay, so again, most common sales would be for promotional purposes, right? Maybe it's a sale of the week. Okay, it could be for a grand opening. Whatever it is, this is where you're going to have to calculate your separate charges for your sales discount. Okay, so again, if it's a store-wide sale, you want to make sure that what you determined is you're going to apply it to every single person in the store. It's not going to be on an individual base, okay? So, when we're going to focus on the in-store only first, okay? Now, with the discount, you cannot, of course, take a discount off of sales tax. No matter how you treat it, whether you look at it, it's only 10%, that covers the tax. No, it really doesn't. You're actually going to still be taxed no matter what. Okay, but in this case, so on June 1st, okay, your store is having a promotion on all items are 40% off, okay? And a customer buys 10 baseball hats with cash, okay? Which the originally price sold for was $10 each, okay? And of course their sales tax is going to be 8.25%. So record this transaction. So what are my accounts going to be looking like? Okay? What do you think is going to happen?
Well, the description
Mm-hmm.
is still cash.
Good.
Okay.
Okay.
And let's see here. But you're gonna have a second description for the debit line with the discount information,
Correct.
correct?
You need to associate your sales discount. Okay.
Right. The real price is the real price. So
The
you're
real
putting
price is the real
debit
price.
line. Okay.
Correct. Now, of course, the rule that governs that is going to be the going concern assumption, right? No matter what happens to your store, you're going to continue doing business as usual. So, whatever price that you established it as, it's going to be whatever you established it as. Okay. So, if you ever gone to the store and you've done and if there's a discount, whatever, if you look on your receipt, you're going to see that you're going to be charged for the full price. Then the next line item is going to be your discounted amount with the negative number. Okay? So you have to keep it separate. Good. All right? And of course, you're going to get taxed on top of that. All right? So let's go ahead and calculate this. Also, you can look at it this way. By having a cash account and your sales discount amount, right? What you're going to say is what you could have earned versus what you should earn, what you should have at the end of the day. Okay, applying the discount as well. So in this case, with this sale that I have, what should be my total sales?
$100.
It should be 10 baseball hats at $10 each is $100. Good. Now you got to calculate the actual discount. What is my discounted amount off of that?
$40.
$40 is correct. And then lastly, so how am I going to charge my tax on that? Am I going to charge it for the full 100 or am I only going to charge it after the discount?
I'm going to say the sales tax is on the full amount.
After the discount.
It's always after the discount.
After the discount?
Correct.
Okay.
Correct. So think of it when you go to the store, right? You have all your line items, and then at the final end of the number, you have your subtotal. Then you're going to get charged your tax. So again, that's why a lot of assumptions when they say discount, oh, it covers the tax. No, it does not.
Still have to pay, but it's not in the full amount, just the discount amount.
Exactly. So you're going to be charged the tax based on the discounted amount. Correct. So in this case, what is my sales tax going to be?
$4.95.
$4.95 is what Michelle got.
Right, same here.
Oh, you got that too?
Yeah.
Okay, perfect. So what is the total amount of cash I'm actually going to be receiving?
$64.95.
Correct. Okay, so in this case, I broke it down, and this is how you calculate it, right? When the first thing you should do is try to figure out what your foundation is as far as journalizing, okay? The way you journalize it and the way that you calculate it is going to be different. So it's always best that you calculate it on the side, maybe scratch a piece of paper before you actually place it into your journal, okay? So again, you want to make sure that you hit every single point and determine, okay, I have a sale. I made my sale, so how much is my sales? $100. Okay, 10 times 10, $100, right? What's my discount off of that? It's 40%. 40 times 10, 100 is going to give me $40. What's my discount off of that? It's going to be 100 minus 40, which is 60. Multiply my tax on that is going to give me $4.95, which I flip in reverse, saying if I'm supposed to have $100, right? And I subtract my $40 from there. Therefore, my total amount should be $60 plus my tax, which gives me $64.95. So again, calculating is also a process itself, okay? And understanding where each number falls in is going to be why you need to practice establishing a foundation and then going ahead and calculating your totals, okay? So in this case, this is what our journal should look like. We're receiving $64 which we potentially could have, right, received 100 in XYZ. Okay? So good. That's what happens when you have an in-store discount. Now, let's say I have a customer, okay? And on July 1st, okay, a customer wants to buy in bulk of 100 baseball hats from your store, okay? And they want to place it on an account. Now, here's where terms come into play, okay? So because this customer is a first time buyer, right? You offer them a terms, okay, in which it's 5%, 15 net 30. Okay, so again, this is where we apply terms which can be used for both vendor and customer. So here, because they're a first time a person with an account, we decided, you know what? I'll let you go ahead and I'll give you a 5% discount upon if you pay within the pay period, right? Of course, each baseball hat was sold for $10 each, and sales tax is 8.25%. So we also added a delivery charge, which is $10. Okay, so what is my journal going to actually look like? Okay, what am I going to be calculating?
Okay, so let's see here. Well, if it's somebody who's going on account, is that going to be accounts payable?
Not payable.
Receivable.
Oh, sorry, receivable, yeah.
Correct. This time, we don't owe vendors. The
Right.
customer owes us. So accounts receivable is correct. That's our first thing that we're going to be looking at. What else are we going to be looking at? Do we grant them the discount now?
It doesn't say which way they want to buy.
Right, because the incentive is we give you terms. So if you pay within the pay period, we'll grant you, or we'll let you have the discount, but that is if you pay within the time being. So in this case, we are not going to calculate a discount.
So we're going to do the gross.
We're doing the gross, yes. Okay, so your journal, right? We got to make sure we have our sales. We got to make sure that we have the tax on top of that because it's 8.25%. And we have a delivery income or a delivery charge, right? We're tacking on, hey, because we don't have all 100 hats right in the back storage. We have to ship it out to you. So we're going to charge you an additional $10 to ship it out to you. Okay? So, how much is going to
We
be?
can't charge tax on a delivery charge though, right?
No, absolutely not. You cannot charge tax on that. It's a completely separate, different charge. So again, this is also known as freight as well, right?
Okay.
Okay, good.
Okay, so the accounts receivable amount then,
Mm-hmm.
oh, we gotta do the whole total for him, sorry.
It's fine.
So let me.
Okay.
So let's see, so the customer is going to be paying, considering he's paying a net 30, $1,092.50.
Okay, and what's the breakdown for that? How much was actual sales?
1,000 for the hats.
Mm-hmm.
The 8,250 is the tax,
Mm-hmm.
and then the delivery charge for $10.
Perfect. So here we calculated the sales, which was the 100 hats at $10. We charged the tax, which was 8.25%, which we got $82.50, plus the additional delivery charge, which is completely separate from the entire thing. So that's going to be included very last. And then now we go ahead and apply, and we add it all together. So he owes us in grand total $192.50. Okay. So now, let's say on July 12th, the customer pays us for their purchase in full. So how do we record the discount now? Remember, the terms was 5%, 15, net 30. So again, they purchased the hats on July 1st, 12 days later, which they do meet the discount period. So how do we grant them this 5% discount?
Okay, so you'll take the $1,092.50,
Mm-hmm.
remove the 5%, which is the times 5% is minus $54.63.
Okay, now question to you. Can
Oh,
you
wait, no, that's the
discount?
whole total.
Yes.
Yes.
Good. No worries. Good.
Let's go back. I was like, whoops, wrong number.
Mm-hmm.
So that's $54.13.
$54.13. That's how much you are discounting at?
Yes.
Okay, try again.
Okay, what am I doing wrong here?
Okay, what else did you include in there?
The tax.
Okay, can we discount the tax? Can you ever discount the government?
No. Well, that's why when I guess that's the part that's confusing me now, because when we do the 40% discount on all the items, we still didn't charge the tax on the full amount. We only charged it. So that's where I'm
Mm-hmm.
thinking, okay, all right.
Yes.
So is it different for this because it's on account? I don't know. I'm totally lost now because I'm doing this math and I.
Okay. So what
82.50 is the total without the shipping.
82.50 is
Without shipping, that still includes the tax. 1082.50
1082.50. Okay.
total without the shipping. Right? So I'm not
Mm-hmm.
charging the tax. So I'm only taking the 5% off of the 1,000.
Correct. Because in this case, you can only give a discount off the actual item that you're selling. You cannot take a discount off tax, and you definitely cannot take tax. You cannot take a discount off of shipping, or unless you offer free
That
shipping.
I know. That's why I say I'm confused because when we're in the pretend store with
Mm-hmm.
the 40%, I'm allowed to discount that.
Okay, now I can take a second to explain that in a minute, but let's go ahead and just finish this calculation.
Okay, go ahead.
So good.
Sorry.
You recognize that you only discount the $1,000.
Mm-hmm.
So what is my total amount of discount there?
Minus 50.
Mm-hmm.
950. Yep.
Okay.
Off the 1,000. Okay.
Good. Now, because we're returning or refunding $50, how much tax am I also refunding? Because I'm not charging them. So again, when we're looking at tax, you're only taxing on what you sell, on the dollar value. Okay? It's not on how many items that you purchase. It's not on how many things that you've accumulated, right? Discount or not. It's going to be based on the total amount of sales that you've incurred in the total price. What did you actually?
Your description, I forgot what the actual question was. Sorry.
The description is okay. So he's paying for our.
The question, what did you ask me to begin with? Now, what are we taxing him? Or
Right.
giving him
Yes.
back?
Yes. Yes. We're giving his tax back because we're refunding a portion of his money, aren't we?
Right.
We're discounting $50. So that's how sales tax works. That's where I was explaining. I was explaining.
That's what I mean. I was listening to your description, and then I had forgotten what the question was.
Mm-hmm.
The question.
So the question is, how much tax are we actually refunding because we originally charged him for the full amount?
So
$4.12.
12 cents, or excuse me, 13 cents.
Yes, because it should be 4.125. Good. All right. So again, he's paying us off, right? Whether we receive cash, right? In this case, he paid us in full, right? So we're receiving some form of cash, either cash or check, right? We know that we have to apply the sales discount, and we need to also give back a portion of their tax back, which we know the discount was $50. The tax that we're supposed to give back to them is it's $4.13. So how much cash am I actually receiving?
$54.13.
That's how much we're refunding.
Oh, sorry.
Okay. But yes. Okay. So in this case, he's supposed to owe us $10.92.50. Good.
Or 37.
Mm-hmm. So the actual cash, because he gets to take the discount, and of course we need to refund the money that we charged tax for him for. Okay. So again, tax is based on the amount of total that you're actually selling. Like your actual sales total. Okay. It's not based on how many items that you sell. It's based on the actual total amount that you sell. Okay. Most discounts are going to be off of the profit percentage. Okay. It's not going to hurt you as your cost of goods sold, right? So most promotions and discounts are off of the profit itself. So again, yes. So in this case, here you go. We recognize that. We need to refund him for the $50, and because we charged him for the full amount in the very beginning, now that we grant him this discount, we're going to refund him the portion for the sales that he has incurred. Okay, and that is it for the in-store sales. Using terms or for wholesale purposes, okay? Right. Any questions on discounts in general? Sales discounts, again. Or, here I'll mention this. Sales discount is also another contra account. It is a contra account to the actual sales because, again, you've already established a price point for your item, your selling price, right, which includes the cost of the item, and a profit percentage, right, the amount of money that you want to incur. What a sales discount is, it's taking away the profit percentage, right, but making sure that you at least are getting something, okay? So in this case, it is a contra account, right? So here's a little course review. So we learned about dealing with making a sales for a periodic inventory, right? All we recognize is either when we sell an item, that's all we're doing. We're only recognizing sales, right? Then we're also dealing with what happens when we have returns or allowances. So again, here is an example of an actual return where we're giving them a full refund. Okay, and then we also looked at what if they attempted to return, but we gave them a discount on top of that. So giving them an allowance, right? We're not giving them a full refund. We're only giving them a portion of the money. So there is that. Okay. Then we looking at actual discounts, right? If we're in the store, usually it's applied to everybody. Okay, so that means everybody can get the discount. Okay. Whereas the more wholesale purposes is using terms, okay, or for people that are given, like, placed on an account, right? So that's what this is. Okay, so, all right, good job, everybody. Okay, so any questions in regards to chapter 6.3, 4, I mean, 1, 2, and 3. 6.1, 2, and 3.
Yeah, I'm sure, because we're gonna do a thing here, right, over
Correct.
the overview.
Okay. So